are deals getting more innovative? Are people being innovative in the way that they're financing themselves and doing deals to keep these things moving along? Because whilst the markets may not be playing ball with us as we'd like, there's still unmet health needs, there's still markets out there to be addressed. And I'm delighted that we have Amy from Evaluate Vantage, who's going to navigate this esteemed panel through what's going on, what's driving it.
Great. Welcome, everybody. Good morning. Welcome to our panel. As Mike described, times are quite tough at the moment for the sector, but deal making goes on, whatever the weather. And I have with me a panel of innovative deal makers and negotiators, maybe, who hopefully will provide a robust discussion of what companies can do and what investors are thinking in these times. I'm hoping we're going to cover all sorts of deal making, from financings, IPOs, through to licensing and partnering. But to start off, just to set the scene, I'm going to ask each panellist just if you could just introduce yourselves and your role, and just answer briefly a quick question. How does the current downturn feel? How does it feel different to previous tough times for the sector? Should we start with Jerome?
Yes, so I'm Jerome van Bevliet. I'm the Managing Director at VIB. I've been at VIB for the last 15 years, roughly speaking, doing basically tech transfer. We are, as an organization, proud to contribute to science, but we're especially also proud to help launch new companies. Some of them you may know. Ablinks, for example, was a nice example there. So we have a portfolio right now of about 34 VC-backed companies, 16 of which we're still a shareholder in. And so we have a number of board positions that we take in those companies, trying to help them along. So to answer the question, I think where has it been different? So yes, there has been downturns. The one I remember most was after the financial crisis, where we saw a lot of in fact, venture capital, early stage venture capital evaporate, or funds really focusing on much later stage, or simply withdrawing in total from biotech. So I think that has rebounded significantly. So we're in a much better space, I think, and actually some of the figures show that as well. Some of the funds, early stage funds, raised quite a bit of capital going into the crisis, based on indeed the contribution of COVID, etc. That the sector made to COVID. There was still an appetite to invest in biotech. So I think that's great. That I think hopefully carries us through a bit through the prediction that was made earlier. Hopefully only a few months, although. But then what does it feel also different? I think we at least in Belgium, we also have a few companies that have matured to a mid-stage biopharma company. I'm thinking of Argenix, for example. So there's more examples to lead the way. That said, of course, I could also agree with the tone that was said before. Certainly, and I'm sure we'll discuss many things. Investors are also looking to rationalize pipelines of companies. It's tough times at the moment. So maybe with that, I give to my colleague.
Thank you. Hi, thanks very much. So I'm Kate Rowley. I'm a general partner with Global Biofund. So Global Biofund are a little bit different in terms of investments. So what we do is specifically support diversity in teams, and we've targeted women-led organisations in bio. So we understand the importance of diversity, what that brings, and the benefits that can bring as well. And we have decided to just stand on that platform and work with other like-minded investors to invest in opportunities where we can see that diversity in the team and that diversity of leadership and thought. In terms of what's different, so I think we are still in a kind of upward trend of data and data that's available. There are more things now in data capture than we possibly ever had before, so we can see an awful lot more. I think, talking to one of the points that came earlier, we're now starting to understand that half the therapeutics we put on the market meet 49% of the population, because most clinical trials are done with male subjects because it's much easier to make sure that women aren't pregnant if you just don't test on them. So in that way, with that push to try and have that more diversity, we can start to understand things an awful lot more. And actually, in the end, we should get to a point where you can better sell your drugs because they're more effective and you're not working in a subpopulation that actually they don't meet the needs of. So I'm quite positive because I think we've got a better ability to capture that data. I don't think we're quite at a stage yet where we can do things with it because we don't really understand it and what we're doing with it. But I think the future's very bright for us, and I think we need to do things smarter, not just harder.
Good morning, everyone. My name's Will Walker-Arnott. I work for a wealth manager called Charles Stanley. Now, we're one of the largest wealth managers in the UK, managing assets of about 25 billion. We're also part of a larger organisation, Raymond James, which is a big US company which manages assets of about $1.3 trillion around the world. Now, although I look after clients who work in the life science and biotech space, I'm very much a generalist on today's panel. So I hope I can add value in terms of looking at the more sort of macroeconomic themes, but I have less of a specialism of investing in life sciences, so I'll put that out there at the beginning. How does this differ to previous downturns? Well, I think the first thing I would say is that the era of cheap money is over. And I'll say that again because it's very important. The era of cheap money is certainly over. What does that mean? Well, it has very big implications for investors like myself. When interest rates were very low, we were much more willing to provide capital to nascent, low profitable businesses. But we've now got to change our calculations because suddenly you look at other asset classes. I can now lend to the US government, which is very much risk-free, and I can get a 4% annualized return for that. So the calculation has very much changed. And this is all down to the cost of capital normalizing. So I think in conclusion to that, early stage life science biotech companies are going to have to work a lot harder for capital from investors like myself. Now there is light at the end of this tunnel, I'm pleased to say, and if you're looking at the macroeconomic conditions, it looks like inflation in the US has now peaked. And if we now start seeing inflation dropping down, that means that the rate of interest rates around the world are probably going to level off, and we can certainly see a terminal rate of interest rates in the US of about 5% potentially. Once we get some certainty about where the new cost of capital is going to be, then I think we will see a relief rally in some of these growth companies, particularly in the biotech life science sector. We've seen some of that over the last 2 weeks, in fact. So there is light at the end of the tunnel, but just to conclude, I think the sector is going to have to work a lot harder to raise capital.
Hi, I'm Julie Simmons. I'm an equity analyst at Panmure Gordon. We're a stockbroker. One of our largest sector that we deal with is life sciences, and I think my head of department would describe us as having raised more money for more companies over the last 5 years than any other UK stockbroker. So we know a little bit about what we're doing. I would say the difference in this compared to the last few cycles that I've been through in terms of life sciences is on this particular occasion, it's not just us. It is the market as a whole is difficult. There are very few sectors that are bounding around going, yay, it's our moment for investment. It covers everything. That, in a sense, makes it more difficult because investors have a lot of other cheap things they can choose from. It's not just looking at healthcare and going, oh, this company's trading close to cash and I think it's got something interesting, so therefore is worth investing in. You have to compare that to across all of the different sectors, be that retail or be that pubs or be that insurance or be that house builders. And so it's become more difficult to get the attention in a way that when it's just healthcare that's sort of out of sync, you can point to reasons as to why there's going to be that recovery. On this occasion, because of the sort of the macro factors, it's across a much broader range. So it makes it more difficult. That being said, I would have said over the last 3 months or so, there are beginnings to be glimmers of hope in terms of the investors I'm talking to, that they're now taking their eyes out of their own portfolios and beginning to look at what else they might be looking at. again, covers everything, doesn't just cover healthcare, but they are now more focused on looking slightly more broadly. So I'm more hopeful about 23 than I was about 22, where I think we were suffering slightly from the drop that healthcare suffered from the highs we saw during the pandemic, which has meant that this trough has felt deeper than maybe it should have done because we were coming down from higher highs beforehand. So I think there are glimmers of hope for 23.
Good morning. I'm James Fry. I'm a partner with the law firm Mills & Reeve, and I head the firm's life sciences practice. So we're a full-service law firm supporting the life sciences sector across biotech, medtech, tech bio, etc., with offices locally in Cambridge, London, and Oxford. So in terms of the work that I actually do, I'm an IP lawyer, so I'm focusing on sort of IP transactions, so partnering transactions, other forms of licensing transactions, which I think was one of the reasons I was asked to join the panel, given that we are seeing a sort of definite shift to clients, given that markets are tight, looking at other ways to bring in cash, which could be through licensing deals. So accumulating license fees, milestone payments, then to plough back into development. I'm sure we'll get into some of those discussions shortly. I would agree. So in terms of what is different this time round, I would agree wholeheartedly with what has already been said. I think one of the other issues is actually that it's happened at a time where there's a combination of a whole range of other factors. Mike talked about pharma pricing within the US. We're coming out of COVID lockdowns, which has had an impact as well. So there's a whole number of things which are really just coalescing. And I think that's sort of driving some of the themes we are seeing in terms of our own practice. I mean, our clients remain generally positive. I think we are certainly seeing some of the green shoots as well. Looking at the sort of the corporate and transactional space, I think our general view is in terms of earlier stage investment, we're still seeing that as pretty resilient. It may be that there's a increasing focus on some of the hotter areas, cell and gene, the rising nature of areas like tech bio as well. But clearly, IPOs, the window is shut or restricted, and in terms of sort of on the M&A side, we're still seeing sort of a number of sort of bolt-on transactions, whether that's on the pharma side or in the med device space. But certainly that definitive shift to looking at sort of partnering transactions, alliance transactions, whether those are with pharma or other providers.
Great, thanks everyone. Perhaps we can just start off sticking with the financing side in that kind of deal making. I'm going to start with Julie. In terms of IPOs, we've heard the window's shut. I mean, are companies, are they queuing up, getting ready to go out the door when the window opens? Are you hearing any appetite from investors at all for these sort of offerings, or is it going to be as normal, NASDAQ opens, then Europe?
I don't think it's as simple as that. I think a lot of companies who have looked to IPO are probably, if they don't have to do it now, they're probably not going to, because the valuation they'd need to take would probably be lower than either they or their investors would want. There are others who might need to do some form of transaction, and if they can do that using VC financing, private equity financing, they'll probably choose to do that first, because they're probably still going to get a better deal valuation-wise, funding that way, and they'd still like to do an IPO for whatever reason. They'll put it off by 12, 18 months. That being said, there are other companies who want the profile of being on the public markets, and they are prepared to look at doing an IPO. The question really is what they're prepared to do valuation-wise. There's one we're talking to currently, was looking to do an IPO 12 months ago, has decided it wasn't going to for various reasons, as these things often take longer than expected, and there's always another milestone that needs to be hit. as it is, they probably will push the button at the beginning of next year, but the valuation will be half of what we were originally talking about. For them, because of the shareholding structure, because of the profile that they're looking to seek to get through an IPO, that makes sense, because they want to do move things on the public markets for various reasons that fits with their business model. But they are prepared to take that hit to the valuation. So I think it's really that question of what you're trying to achieve out of an IPO that is going to make the difference to individual companies. Some of them are going to be more comfortable just leaving it for a little bit longer if there's financing available. Others, if they have other reasons for wanting that listing, are prepared to take the hit to the valuation. But yeah, ultimately it comes down to valuation and liquidity. At the moment, there are lots of cheap things to choose from on the stock market. So therefore, why, if you're an investor, would you choose a company you don't know, a management team you don't know, and invest in that versus something that you've been watching for the last 3 years and you know the share price is low because of specific events which were out of management's control? You'd probably choose the one that you've been watching and you know the management of rather than the new one. So there is that discount that we always see, we describe it as an IPO discount, which is essentially because it's a new entity that investors don't know about, it's going to be higher. And so that's sort of the main factor really.
And I guess that speaks to what you were saying earlier on, that companies are going to have to work very hard to get, or biotech companies, to get investors interested at the moment. I mean, what would you, if you could give advice to a company hoping to float or trying to attract the attention of a public company right now, could you give any advice or?
Yeah, I mean, there are certain concerns we've got with the general life science industry at the moment, and maybe I'll just paint some of those now. This will duplicate some of what Mike was pointing out earlier, but I'll go ahead anyway. So, I mean, some of the concerns we've got are governments doing enough to support the industry? And we would agree that what the Chancellor did with the UK tax credit system at the autumn statement is not helpful. It's not going to stimulate R&D in the sector, which is a concern. And obviously the strangely named IRA Act in the US is also going to put US drug pricing policy under the microscope again. So what can participants in the sector do? Well, lobbying becomes increasingly important, and that's something that people have spoken about already. But you can support groups like One Nucleus, and Tony can give me a $5 later for saying that. But that obviously does help. So that's something we can actively do. One of the concerns we've got as an investor at the moment is the sort of COVID headwind which is coming across in 2023. So I think there is going to be an erosion of sales to the tune of about, according to our estimates, of about $75 billion. And this is just sales relating to diagnostics and vaccines all falling off. So it's really important that companies are open and transparent with investors from the outset and don't try and hide these issues and make sure that they are, as I say, completely transparent. The other issue we have is obviously cash burn, because, as I said, it's going to be a lot harder for companies to raise money in the current conditions. So companies need to think about how they're going to raise cash, not just from investors like myself, but also be slightly novel. And there are interesting financing techniques around in terms of royalty deals. These can be synthetic, i.e. before they've had their regulatory approvals. And obviously partnerships with big pharma is important. So those are some of our concerns and some of the ways that maybe you can look through those. But I mean, it is going to be difficult. I mean, at the moment, we would prefer to put our money in big pharma, to be perfectly frank, because it's been a very resilient performer over the last 12 months. And you look at some of the companies we invest in, like Novo Nordisk and AbbVie, they're trading at all-time highs. They've shown that they can be resilient during a downturn. But as I say, as we get more accustomed to the new norm, interest rates of 4 or 5%, if that begins to turn, then I think biotech and life science early stage companies will have their day again.
Okay, great. But perhaps we can turn round back to the kind of the early stage of the cycle now, which is where I think you come in, Jerome. You're very much involved in the company creation stage, kind of different types of deal making at that end. What kind of challenges are you facing at the moment? Are you having to think differently when you set up these entities?
Yes, typically, I mean, the way we feel it is that we have to incubate projects for much longer. It's a logical thing. The industry is more risk averse. Investors are more risk averse. They want to see more data before they believe we can build a viable business out of it. So that's a very practical way, but also it goes much deeper. This goes in cycle, but we have quite a number of what we call platform technologies, which you could apply across different type of indications or even broader fields. We've been successful with that, with the nanobodies in the past, and meanwhile we have 7 companies using those. But you see, right now with the climate there is, people are really hesitant about these more disruptive type of innovations. Even though, if you would have asked me a year ago, I would have probably been more. I mean, look at what COVID showed us, right? The mRNA field just boomed, and it was a totally new platform, and the industry proved that this could be, you know, from something that was 10 years in development, suddenly in almost a year's time. You know, everything can. It's a fully accepted modality. So we have to sort of withstand these. I understand the trends, but sometimes it's a bit. It feels like short-sighted from the innovators' side. That's one. Second, I would say there's also a role to play here for pharma companies. I think pharma companies, as you say, do well. They've also done well through COVID. I shouldn't forget that. I mean, there's huge piles of cash that have been generated. So I think they really should take up their role more in terms of, for example, through their investment arms, their corporate venture, invest also in these earlier stages. I think this is a role they have to play. I think they typically regard these projects very much more like they would sometimes look at an in-licensing opportunity, i.e. be very thorough and very risk-averse in a way, but you have to realize if you haven't had financing, you cannot have addressed all the questions that, you know, we also know are still there. So I think I'd really implore on that. The other thing I would also hope, and I think this is the right moment for it, is impact investors. I mean, there are still investors out there, foundations, but also that simply want to do the right thing as well. I think this would be the moment for them to step up. And there are biotech companies that are working on projects, products that are extremely important for society to have now, not tomorrow, now. The COVID antibodies is a good example. They've all pretty much been withdrawn. I mean, this is an area where doctors are screaming for antibodies. There's a huge unmet need. If you're a transplant patient right now and you get you capture COVID, you're on a death list almost. So there's real unmet need. Right? That's the mantra. If you have a good unmet need and you have a good scientific proposal, the investors and the pharma will follow. Actually, at the moment, it's not. So that leads me to think that the market of investment and deal making isn't functioning properly because of some macroeconomic trends for sure, but also just because of just fear and not always rational. Let's put it this way.
Yeah.
So
yes,
just
I
a
mean,
few thoughts.
Everyone, you know, M&A is always supposed to come to the rescue, and I think that's what Mike raised earlier. And we have seen some decent deal making, but I don't think we've seen a lot of the sort of the level of partnering we would expect. And
Exactly.
I would imagine it's quite hard when the power shifts from the high value companies who can raise money to the pharma company who knows they need that money. So James, perhaps I can bring you in. You know, when you are sitting across the table and there's a big company and a small company at the other side, I mean, how do you help that your smaller clients keep some power? How do you negotiate? I mean,
No, absolutely. I suppose I see it on both sides of the coin in that we act for biotechs in the main, but also we do these kinds of transactions for larger pharma as well. I think number one, it's understanding the objectives of the collaboration, partnering transaction for both parties, because that may drive the negotiating position. Mike mentioned Humira, but there's a number of drugs coming off patent in 2024. So pharma needs to rebuild its pipeline, and so it's looking around at those new technologies, and so that really drives a stronger negotiation if the smaller biotech is on the other side. But I think there are some key things to be thinking about in terms of sort of maintaining that position with any contract negotiation. So I think first of all, it's staying true to your own objective. What is your own strategy? If it's a platform deal, it may be that actually your model is an out-licensing model, or you're actually going to be developing your own programs. But actually understanding that strategy and staying true to that strategy, I think, is absolutely key. And I suppose one of the things to think about in terms of almost keeping yourself on the right side, a use of term sheets. I think it's getting the balance right with those term sheets, and I think large pharma will want quite a bit of detail within the term sheet for the transaction. But it does allow you, in terms of smaller biotech, to almost sort of checkpoint the deal as you go along. And actually, when you get to the final stages of the negotiation, you're able to then look back and true up. So term sheets are always useful. Is it going to fit for us? Do we understand the objectives on both sides? I mean, a partnering deal is a collaboration deal, and many people say actually it's win-win. It is in many ways in the interests of the larger pharma company for the collaboration to win, for it to work for both sides. So there is always that dynamic. Thinking about your IP strategy is absolutely key. What is the hook for the biotech? Clearly, it's your resources, your people, your technology. But how does your IP strategy fit with that? And actually thinking about that in the context of the transactions. I would say this, wouldn't I? But actually, it's also having the right advisors on those deals. People who understand the norms within the industry, but also internally as well. Your BD team, in terms of being able to do the comparative analysis between the deal that you're looking at and what others have done. So there's sort of a number of things to sort of take from the shelf in relation to that.
Sure.
Just on M&A, it's worth making the point that actually Liz Truss did a great service to the sector by trashing sterling so much. So that will make a UK life science and biotechs much more attractive to international investors. I know we've had a little bit of recovery in sterling in the short term, but it's still very cheap on a historic basis. So that does create opportunities for overseas acquirers.
It does.
So perhaps I can bring Kate in here, who's been waiting patiently. I know that ESG and diversity is, you would argue, is very important for any company to consider right from the beginning. I mean, presumably from outside investments perspective, particularly. So, I mean, when everyone is thinking about cash conservation, and at the moment for small companies when it is tough, I mean, how do you keep that up on the agenda?
So one thing that I think you're starting to see an awareness generally within the market from investors as well, and also kind of, I know I talk to a lot of large farm companies, and large farm companies have this very much on the forefront of their agenda as well, about ESG, about the impact, about what it is that you're doing. Again, in that area of kind of cash conservation, I always think when kind of like scarcity tends to drive innovation, so it drives people to actually look for opportunities where they might do things differently. And I think we would argue that actually having diversity of thought and decision making is a bonus. If you look at the research that's been done, diverse teams get better exits and they get quicker exits than teams that are driven largely by men. Because, I mean, I know that Mike made a mention that 2021 was a bumper year for investment in the VC area, and it absolutely was. And the investment in women-led teams reached an absolute peak of 2.1% of all those ventures that are invested. That's the highest we've got, with 51% of the whole world. So we have to do something differently. And if you can get that diversity in teams, you can get that diversity of thinking, you then have other options or other ways of doing things that can be more productive than the way that you've done things traditionally. And I think this is possibly one of the things, again, going back to the pharma way of doing things. When I've looked and observed and worked with large pharma for a while, they have a set way of doing things that has not really changed. They haven't really needed to innovate because they have had quite a lot of cash. Now when things are getting constrained, they're thinking, actually, do we need to do that? Do we need to go in this area? And I think that's some of the shrinkage we see is we don't necessarily need to have more people necessarily involved or more resources going in that direction. Let's do something a bit differently and work out how we can use our data more effectively, how we can work better as teams together.
Yes, and I mean, presumably, if you're being screened for a takeover, then if you I mean, not just tick the boxes, but walk the walk as well as talk the talk. It will help if a bigger acquirer comes.
It absolutely does, but as been highlighted previously, one of the key things is the management teams and familiarity of the management teams. The counter to what actually I just said is a lot of it is about risk. So anything that you look at is perceived as risk because it's not something that you're necessarily already involved in and that you haven't actually already acquired. And the problem with that is the people that tend to know all circulate in the same circles. There was I think it was a Times article the other day talking about all boys networks within investors and VC investors. And if people don't know your face, then they won't invest in you because you're not a known entity. So again, what we can do is make sure that more people are there and talking to investors and are known and are building those relationships from a very early stage so that by the time it comes to a point where you seek investment or you're looking at acquisition, people actually know your face and they know you as a known and trusted entity.
Yeah, I mean, is it a factor in the deal making that perhaps you see?
I was going to add absolutely, yes. I think in terms of deal execution, negotiation and deal integration, I think it's absolutely key in terms of diversity of team, particularly in a partnering transaction, because you're going to need to work with your pharma partner or your other biotech partner for a period of time. So diversity of team, I think, really drives that. I think you do deals more quickly and more smoothly and smarter as well with the diversity.
Maybe just to add a wild thought, perhaps, but we're also so much used to having the CEO, one CEO, and then it's like we still think of these Christmas trees. Whereas, for example, our institution, I'm managing director with a co-managing director, a female colleague, and actually, I find this is very liberating because it feels a lot less lonely. That's one. Second, actually, the diversity is walk the talk. I mean, it really happens. You look at different. You're in the situation together, and you look at it differently, and you sort of complement each other. So, I also wonder whether perhaps we should innovate a bit on the CEO, CFO, the sort of that type of model. Of course, it requires. It's perhaps another risk, but we're still stuck to Henry Ford's idea of management.
New management structures as well as new deal structures would.
I mean, I think that's right, because I think if you think about a CEO and executive team, then effectively the CEO shouldn't be in the weeds with everyone else. The whole point of having an executive team is that everybody knows. So that collective responsibility, that shared knowledge and that shared input is really, really valuable. So I think breaking the mold, I think doing things differently is what people should be looking for now.
And is that something you see from the bigger, I mean, you obviously talk the big investors, is it a big issue coming up the kind of the agenda for the...
Yeah, I mean, we now have a regulatory requirement to look at ESG factors, so that will include things like governance as well. But I've got to be honest, in our industry, it's still very archaic. As investors, we're still very much a male-dominated environment, and there is an onus on us, and we are trying to do it, to improve diversity. EDI is increasingly coming up the agenda, but I've got to be honest, the pace of reform in the investment community is glacial, so a lot more needs to be done, not just for the companies we're investing in, but us as investors as well. We need to make the changes our end. So there is a duty and an onus on us to make changes as well.
Yes, I mean, I suppose we haven't seen deals fall apart for ESG reasons, but presumably it's a risk. It could happen at some point.
I think it is. I think that you are battling a challenge. So again, it's that whole thing of like, you look at female entrepreneurs that go and pitch to investors, and they are asked different questions in different ways. And there is lots of studies that show that people recruit like with like. So where a lot of investment companies are all full of men, then they will tend to then recruit people who are men because they are a known entity. There's less risk. For me, if we can push and drive diversity in teams and different people and different approaches, that then people can become more comfortable. But as you say, it's a bit of a glacial approach, so we kind of have to do something different. We as a fund are a small fund. We are not big enough to really move the needle on the deals that we participate in. We very much syndicate with other people. But what we do is become a bit of a thorn in their side to say, you need to think about this. This is the best way forward. It is the best way of doing things. Even regulators are holding people to account for it. You need to do something, and it needs to be more than just lip service. It actually, if you do it, will make a difference. So just do it.
Ignore it at your peril.
Yeah.
Okay, so another theme that I was hoping that we could discuss is we've obviously seen a lot of private equity come into the biotech sector through actively buying the venture capital arms and through direct investment as well. I mean, is there any sort of deals that perhaps my panel members would like to see emerge from these? I mean, they've got a lot of money, the private equity. I mean, we've seen the clinical co-development model that Abingworth kind of has pursued with them. But, you know, they've got a lot of money, and presumably they could put that to work imaginatively. I mean, I don't know if, Jerome, if you've got any, what would you say to these people? What could they be doing to help? What deals would you like to see them doing?
Yeah, of course, I don't have the crystal ball that Mike didn't have either, but I look at this with some trepidation in a way, just because, okay, the rationale that many of them put forward, on the ones I followed a bit more closely, was okay. It will help us raise funds, because for a venture capital fund, it's really labor intensive, and then of course if you're in a bigger group, that part goes easier, and that's a fact. I think also some of those deals were also sped by simply just investor dynamics, or that's the other part. And I just worry on the long term. In the end, that's going to be a company with a portfolio of private equity business and venture capital. Private equity business with a shorter term horizon of 5 years. Yeah, I was going to say 4 or 5 years. And then venture capital, which should be probably, actually, depending on the stage, 12, 13, 14 sometimes. I mean, this is vastly different. So there I worry a bit. I think that over time, not in the beginning, because they have to hold true to what the selling story was, but over time, these type of investments will come under pressure vis-a-vis private equity. A good thing that might come from that, however, is the approach where that's much more ingrained in private equity, because I used to work at Bain, and we've seen a lot of these cases, where you actually, what I would call, develop an industrialization strategy. We see many early stage biotechs that reach, for example, up to a Series B, but then they're still a small company. In fact, right now, they actually probably even have to trim their pipeline. Whereas if you could say, you build a key investor builds a strategy where you can actually combine or, do a merger and acquisition, or a merger, in that case, between two smaller biotechs and build a bigger story that has a better team and a better case. I think that could actually be a real opportunity. So if those type of deals emerge from that, I'll be very much in favor, because I think it's going to lead to resilience of the sector. The aim should be that we should have a next generation of mid-size biopharma companies that are revenue generating, that can be independent on their own, because let's face it, the pharma companies, even though we like them very much, it's the same names for there is a huge waves of consolidation, and then nothing has changed. So I think a bit more diversity in that landscape would also be a good thing. And there I think those big PE firms can perhaps help implement some of that thinking. Just some thought.
You have an opinion on that?
Yeah, no, I'm also quite sceptical about the PE sector and how they can help in biotech and life science. To be honest, I think there's going to be quite a big reality check coming down the road, and there's been a lot of hubris surrounding the sector. And I say this for a number of reasons. Firstly, it's supported obviously by cheap debt, private equity, and as we've already talked about, that's no longer accessible. There aren't many exit routes for them at the moment because the IPO market's closed. So if they want to get out after 5 years, it's going to be quite difficult. They've been very slow to mark down valuations. So we've already seen from Mike that The Nasdaq Biotech Index is down 10% this year, but we haven't seen that in the private equity space at all. So we still got to see a lot of those write-downs coming through. It's less efficient, the sector, at valuing companies, and we still got those write-downs to come through. Part of the private equity sector also looks like a bit of a Ponzi scheme, to be honest, because you often see private equity selling to other private equity companies, and at some point this house of cards is going to fall down, to be perfectly frank. So, and the final issue is one we touched on, is they're impatient. I mean, they've got investors who want their money back after 5 years, so they probably haven't got the same patience as the VC sector. So I'm not sure it's going to be the great white knight that it's been made out to be.
Julie, do you have much dealings or thoughts on their future here?
I think what it does do is it potentially opens more of an opportunity for some of the VC crossover funds, which have also got private equity now involved. Because what we have seen over the last 12, 18 months is a bit of a change in what they're looking at. Because historically, they'd always been investing in sort of late-stage private companies with the aim of taking them to market, usually on Nasdaq. What we've been seeing over the last 12 months is, maybe slightly longer, is they've now started looking at the public companies with either the potential of looking at them in the UK to list them on Nasdaq at a later date, or looking at them as sort of quasi-private investments where they're not necessarily looking to move them off market to take them private, but what they're doing is they're funding them and then taking them with the aim of maybe M&A at a later date, or an IPO on Nasdaq, or a different approach at a later stage. Because once they take large shares of these, they're essentially illiquid. So there's they're not a sort of properly trading sort of listed company in that sense. But it's quite interesting because it offers other opportunities, and the reason we're seeing it is because of this disconnect between private valuations and public valuations. Some of the public company valuations are so low at the moment that why would you be investing in a highly valued private company that's attached to the value of its last round when you've got something trading on the UK or even in Nasdaq at a valuation that is 20% of that? You wouldn't. You invest in the best technology at the right price, and so it is changing the market. And I think with the private equity companies coming in to be involved in some of these VC firms, it gives them a bigger pool of capital to play with from that perspective. And then, they're not necessarily looking at holding them for 15 years because some of those quoted companies are actually relatively mature. They're just very cheap at the minute. We've seen it a couple of times in the UK market. I think we will see more of it because certainly every crossover VC I talk to is as happy to talk about public companies as private at the moment.
Are you seeing many of them coming to the table, trying to?
We're seeing that sort of the nature of sort of biotech clustering. Funds building a platform with different biotechs. So we're definitely seeing that. More on the partnering side, we are seeing a bit of a shift to sort of more strategic partnerships between biotech and pharma, whereby a shift really from sort of single asset deals to multi-asset deals, but working across a whole range of different programs. So not just the one deal, but a series of those transactions. So really a shift to those a more strategic partnership between either that's peer-to-peer biotech or biotech pharma.
Okay. Yes, I mean, I think, Jerome, I think you mentioned the point that it's long been the desire in Europe or in even the UK to kind of put together kind of smaller companies to try and create a bigger entity. But I mean, I don't know if that effort has anyone's actually tried it in reality.
Yes,
I mean,
well, actually,
people try. People try.
And then they get bought by pharma and disappear.
yeah. I mean, in much the same as a pan-European stock exchange, it always seems to be the thing that everyone wants, but I'm not entirely sure we've ever seen anyone actually try it. But perhaps we could take the opportunity for some questions. If anyone has anything probing for our panel.
With government sentiment souring, what's your view on deal making in China?
Any experts on the?
I mean, I can give an overview of China. I mean, as a house, we're very nervous about what's going on in China, and we have what's called an underweight recommendation on it. So we're not, as a house, investing in China at the moment for for two main reasons. Number one, the property sector over there has been a disaster, and the Chinese government has tried to cool the sector there, but it's had a big knock-on impact on the economic environment. And number two, their handling of COVID has been a disaster most recently, and they now find themselves in this position where they're trying to ease COVID restrictions, but they haven't got their population sufficiently jabbed, which could take up to 6 months. So it's going to be very, very difficult there. And so as a house, we're staying well clear of China. We think the economy there is going to struggle. In terms of Chinese companies, well, President Xi has really been cracking down on companies which have shown any entrepreneurial skill or ambition. And you've seen that particularly in the tech sector. And you've seen some pretty big companies being humbled. You just think of Jack Ma and Alibaba, and that will have knock-on implications to just entrepreneurism in the sector. So I'm pretty sceptical about China at the moment.
Yes, that's an interesting question on China. I just wanted to follow up on what about the other way around? I mean, Chinese companies are still investing in biotech over here. So do people feel that should be wary of that, or continue to take Chinese money where that's available, or licensing for Chinese rights, for instance?
Anyone had any?
There's a number of ways in which you can structure those deals. As you say, actually, you could license geographically into the market. I mean, one of the issues you always need to think around are some of the sort of regulatory constraints nowadays. We've got the NSI Act within the UK. You've got CFIUS within the US as well, which may require governmental approval in relation to some of these deals where you're falling within the relevant areas within the legislative framework. But I mean, there's a number of ways in which to structure those deals, and one way would be to deal with it in terms of sort of separate geographical licensing. I mean, the Chinese market, except that it's going to have some challenges, but it's still a major market with some opportunity there.
Yes, I mean, I think even the regional licensing deals is something that I think we have seen that's been quite strong this year, and I think that probably is another way of small companies to raise money from different sources. I think yesterday, we saw one of the most remarkable deals in between Summit and Akero, who paid 500 million up front for a Chinese bispecific. If anyone from those companies is in the room, please come and talk to me afterwards. I'd love to hear about that deal. It wasn't a typo, it was 500 million. Yes, any further questions?
I have a question, please. Sonia Mike-Schack, Seniors Health. I would like to bring it back to the UK now. And you mentioned that you're more inclined to invest in bigger companies. But when it comes to the small biotech companies who are very often have valuable asset that the market needs and the patient needs, if you were to offer 2 pieces of advice for those small companies, what would it be? How should they behave in the next year, which is going to be difficult?
Would you like to start, James?
I think in terms of those key themes, I think ESG is a key one, and I think going forward we sort of had a discussion around that, but I think it is going to be a key focus area for any business requiring funding going forward. And then I think you come back to the age-old drivers in terms of management team, tech, and strategy. It's a tough market. It's about how you differentiate yourself.
Maybe I can comment. It's obviously not UK, but I think it's very similar where we are. We see a lot of, quite a number of companies, in fact, with great data, of course, in their early stage, but really, I mean, everything goes to plan. and still having trouble. Normally, you would expect these companies go on to raise easily, and that's not the case. And I think one piece of advice I would perhaps give is to really work with your insider investors, even more than you otherwise do. Really get them, even on a one-by-one basis, to really understand what their drivers are, what their concerns are. We've seen already, even in those early stage companies, a bit of trend down in the pipeline also, because there's always a difference in terms of maturity between different programs, etc. So really showing as a management team the willingness, like, okay, we feel the pain as well that the investors feel. We want to put our money where our mouth is, or do what's necessary, but use that as an occasion to build a relationship, because I think really relationships are very important, especially when it goes rough, when the sailing gets rough. And I see that insider investments need to show their commitment, and that's certainly us as a founding entity. We always take the company view and try to help where we can to sort of weather the storm. So I think that also helps if you have investors or founders or institutes that are your founder. Try to have that discussion with them. That's certainly what we do, going from simple things, looking for space was mentioned, to even sometimes the accounting and the HR, etc. So so voilà, just trying to be make the challenge feel as one challenge for all. That would be
I think also I would say looking at strategy, so looking at kind of where your next step is going to be, what the milestones are to get that next level of funding, is what you're working on now, what you need to demonstrate to get that next level of funding. And if you don't know that, go and speak to the people who are the funders to understand what it is that they actually want to see, as opposed to what might be interesting to work on. And make sure you also have that long-term strategy as well. So even if you're not going to take it to the market, even if the plan is that at a later stage a large kind of multinational may acquire you, what's the reimbursement strategy? How long does that last? Where are those timelines? Show that you've demonstrated that you understand the whole of the life cycle to get this into the market and get to patients, how long that's going to be and how much that's going to take. Because the more you can demonstrate at this moment in time that you understand exactly what it will take to get there, the more confidence people will have with you. And then it's a case of, right, okay, this is the minimum we need to do so we can conserve as much cash, and then work, as you say, with existing investors to say, if you can get us to here, we know we can demonstrate everything the next level of funders need, and warm those relationships really early. So I've worked with an awful lot of companies that have got a single investor that is a public sector investor support backing a project that is based from, say, Innovate UK funding, and there's no one to take the funding on from there. So you need to get people in early to understand, and get those people in that are going to do those subsequent rounds and all have friends that they can circulate it with.
Yeah, I mean, Julie, I mean, when a company needs funding next, I mean, how soon should they be talking to you, or their investors, you think, before that stage?
The most successful IPOs we do, we've known the companies for a couple of years beforehand. So we don't want to talk to you 3 months before you do your IPO. Those are usually a complete disaster, because those are the ones where we discover halfway through the process that there's something that really we shouldn't, that needs sorting out before we take you out to investors. So the most successful ones we do, we've worked with companies for a couple of years beforehand. And it's not that we're telling companies what to do, but it's just a matter of getting the structures in place. So you're checking that you've had your numbers audited appropriately early, so that there's not going to be a nasty surprise when you do the one that you're doing before your immediate IPO and your revenue number wasn't what you thought it was because of some IFRS accounting. And the presentation has been building to the right level, and you've answered the questions, and your ESG is in place, and all of these things, which they don't all have to be done just before you do your IPO, but they probably, if they are in place and you've done them gently over the previous 18 months, it just makes the process simpler. You've got enough on your plate when you're trying to go out and see investors and write the mission document. You don't need to be doing all the basics at the same time. And so, and from the point of view of my side, where I'm an analyst writing on the company and essentially writing the sales document. Although that's not how you describe it really, but that's what it is. Yeah, it's helpful for me because that means I've started looking at what your competition is doing, what's happening in the market. I've got 2 years of, oh yeah, that company was doing that. Let me just read that article that I might have put to the bottom of my reading list. And I'll have that background knowledge, which makes it much, much more compelling when you go out there to talk to people and to be able to say that, yeah, they've hit their numbers for the last 2 years. Because I know that, because I've known the finance director for the last 2 years and they've hit every set of numbers. Yeah, so those are the successful ones, where we've known you for a long time beforehand. And it's not an intense relationship, it's just seeing you once every 6 months. But knowing that the milestones have been hit, knowing that the things are in place, makes a huge amount of difference.
Yeah. Detailed business plan, right?
Yeah, I think the same holds true for pharma, because that's the other part, a piece of advice. In the end, at least early VC investors are driven what pharma want, and that's very much sort of like, okay, what have you heard? What have you heard? If you can speak to pharma at the right level of the R&D people, and you can have this relationship where, okay, they've also seen you hit your milestones, not in terms of sales, but in terms of, okay, what you set out to do. I think that will actually drive and give your investors a lot more comfort. So, yeah, it's been said many times before, but I think I've seen it happen.
Okay, I think we've got time for one more, Tony, or do you?
If I can ask you.
Yeah.
So one more question.
Please, yes.
Actually two. One specifically for Kate. Kate, how do we make you more successful? Fantastic to, yeah, if you need some help with finding some LPs, I'm up for that. More generally in the panel, you know, we have a situation where we have a patent cliff. We've had fewer new drugs approved this year, so we have an innovation gap. We have a cost of capital also divided by a cadence of capital into the sector, so innovation is being squeezed. There's one group of VCs or investors that do need to spend their money, and that's corporates. And you've seen with Danuta and Nucleome them do a $37.5 million deal into what is a fairly early stage company with 3 corporates. Can the panel talk about, you know, how they feel corporate venture can be wrangled and what are the pitfalls to avoid?
I'll chip in, yes, please. Yeah, so we are looking for investors to invest in our fund. We're also looking to people to syndicate with, so we will do that. Just very briefly answering corporate from our perspective. We've spoken to an awful lot of corporates when we've been doing fundraising, and one of the challenges we have is just awareness within the corporates of the different parts and areas. And people end up with kind of, I think, different agendas in terms of who's funding what and when. So again, for us, the corporates are really being pushed to drive an ESG strategy within their own organisation. But when you talk to them about funding a fund that is specifically around women in biotech, they're like, we don't have the specialist in that, and it's not really for us. So I think it is that thing of, again, relationships, building awareness, making people know about things.
Jerome, do you have dealings with corporates?
Well, they're certainly around, and they're investor in some of the funds that are early stage VCs. So certainly in that way they are. But I think I agree with you. I think we should. One thing I think we should just all push the message. I think one thing that I do would like to see, and every corporate venture fund is a bit different. Some are really tied to the TAs. So in other words, you're still stuck in a way to the scientific evaluation by the therapeutic area head, for example, before the venture capital company can actually invest in an early stage startup, which means that, of course, yeah, pharma R&D executives are used to the projects they get to see from their internal organization have been incubated for and have spent a lot more money on them before they come to them, versus this outside idea, which actually might be disruptive. So I feel that model constrains them in terms of risk appetite versus the role they should play, I think. I'm a big proponent, because obviously when they do join, I mean, the idea is obviously that they bring this insider knowledge of what is pharma looking for from the discussions they have internally. They can help with, they have technical expertise, obviously. So I see a great benefit, and indeed there's capital there, and they should look at it indeed as a way to stimulate innovation for them later down the road for the pipelines. But okay, that's just a general statement.
Anything to add, or shall we run out of time, Tony?
Just going back to the reimbursement plan. Just coming back to reimbursement and market access, and what's your plan, even if you're not going to take it all the way? I hear a lot more about, with the cost of drugs hitting hundreds of thousands of dollars, if not millions, payers are going to say, well, okay, let's have a subscription-based model. If they're going to be curative and worth that, you pay some up front, but then it's keep the patient disease-free, so it'll be spread over. What will that do to the deal structures, and what will it do to the markets in terms of how you would value those?
Tricky one. Yeah, I mean, I guess, James, when you're negotiating for people, I mean, a lot of the deals have quite kind of near-term milestones negotiated, don't they? I mean, have those long, and who knows who's going to be the owner of that asset in a few years' time? That must be a very complicated.
It clearly may impact sort of how you structure your milestones, which are usually sort of in a partnering transaction in terms of them being multi-layered. So how pharma will approach the negotiation of those milestones will clearly different, because it will be a different pricing and reimbursement model. But if you look at those, classically how those deals are structured, you've got your license fees, your milestone payments, and then your royalties. But I think where it's going to focus will be around milestones, and maybe checkpoints around the development of those the product would be my view.
I think that's true of valuation as well, in that certainly as far as equity investors are concerned, they'll build in the near-term value. Anything else they want as upside. So if you do a deal with a sort of very royalty-based over a long period of time for the sale of an expensive product, they're not going to count the end part of that in there at all. They want that discounted back, so it's effectively worth zero. So it makes them much more. They're always very focused on the near term anyway. That just makes it even more so.
Okay, great.
Thank you very
Well,
much.
thanks. Thanks, everyone.